Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are talking about some of the top stocks to buy right now that are very cheap. So we're going to try to keep these stocks below $10, and I'm going to go through 7 of them, and we're going to start off with Destination XL, ticker symbol DXLG. So Destination XL, also known as DXL, is one of the country's largest retail brands for men, and they normally sell big and tall clothing. The company got absolutely demolished in 2020 back when the lockdowns were happening because they had to close many of their stores, and this impacted their revenue very negatively. However, DXL's management team actually worked very efficiently and effectively to renegotiate leases, cut down administrative costs, and even cancel orders so they could keep some amount of cash on hand to survive and weather the lockdowns. Thankfully, they already have a very solid online presence for their websites and their retail stores, so they got to sell clothes that ways over the course of the lockdown. However, now the company is taking advantage of the resurgence in people buying retail and clothing, because clothing was one of the largest categories that has been increasing for consumer spending, which is fantastic news for this company in particular. The sales for the quarter weren't just up 42.6% year over year, they are also up around 14% more than they were before the lockdowns even happened. The CEO even commented about this, and he says, and I quote, "With our strong balance sheet, we believe we are well positioned to pursue an aggressive growth strategy. At the end of the third quarter, we were debt free and had cash on hand of $6.9 million. So this is absolutely fantastic for a company to weather various lockdowns by cutting back on their various costs and then paying off all of their debt, on top of them having a good amount of cash on hand of $6.9 million. Over the last 12 months, the stock has absolutely skyrocketed, and they posted a gain of over 1,900%. So if you were invested into this company during the lockdowns, and then after the lockdowns, you would have had an extreme payday. However, what do we think about the stock right now? Well, according to Portfolio Grader, they rate the stock as a good buying opportunity because it has an A rating. The current stock price trades for around $5.06. The low-end price target is $11 per share. The average price consensus among analysts is $11, and the high-end price target is also $11. The main reason for why the low-end, average, and high-end price targets for this stock are all the same is because only 2 analysts are covering this stock currently, and they both are in agreement about the price target, which is still lower than their current price. So potentially we could see the stock double over the potential next 12 months, but we're going to have to wait and see. Now, the next stock we're going to talk about is Entravision Communications, ticker symbol EVC. So Entravision is a media and marketing company that specializes and focuses their marketing and opportunities on the Hispanic market. They offer a wide range of various marketing services, including digital marketing services with TV and radio. They operate around 54 TV stations and around 47 radio stations, so this gives them fantastic opportunity to market basically anything they want. They are also increasing their global reach, and that's the main point of this company, is that they want to expand beyond the United States to the global Hispanic market. The company is clearly in growth mode due to its series of multiple acquisitions lately to expand its global presence, because again, that's the end game for this company. They want to go international, and they want to solidify themselves as one of the best companies for media and marketing in the entire world. However, this is a far cry from where the company is currently at, but they have big dreams. The company currently delivered a return of around 101% over the last 12 months, and with the increasing demographics that they've been having and more people entering and watching or listening to their TV and or radio stations, this is just going to help the company grow even more. And of course, according to Portfolio Grader, they rate this company as an A stock. So the current stock price for the EVC stock trades for around $6.31. The low-end price target is $12 per share. The average price consensus is $12.50, and the high-end price estimate is $13 by the beginning of 2023 is the current projections according to analysts. Right now, only 2 analysts are covering the stock currently, so I wish more analysts analysts would be covering this stock so we could get a better range of various price targets, but we'll take what we can get, and this company is still trading below their average low-end and high-end price targets, so it could be a good potential deal. Now we'll move on to another stock that many people are buying that's pretty cheap, and it's Information Services Group, ticker symbol III. This is a Connecticut-based information services group company that describes itself as a global technology research and advisory firm. So although this sounds very impressive, let's see what the CEO and how the CEO kind of describes and points out the record-setting third quarter results. So he says, and I quote, "Enterprises of all types are accelerating their technology investments coming out of the pandemic. We are seeing a strong shift to cloud-based platforms and all things digital as our clients address the requirements of remote working, engaging with customers, improving resiliency, and enhancing the quality of our business." End quote. Over the last 12 months, the stock has increased by around 80%, which gives investors, if you were already into this stock, very good upside potential in a single year. This would beat, say, the S&P 500 or ticker symbol SPY or VOO by almost 8 to 9 times, and Portfolio Grader also rates this company as an A. We want anything above a B+ rating for Portfolio Grader. We have analysts that say that the III stock is currently trading at $7 per share. The low-end price estimate for the stock in the beginning of 2023 is $8, the average price estimate is $10, and the high-end price target for the stock is $11 per share. And again, we see that only 2 analysts are covering this stock, so we should take these price targets with a grain of salt. However, if we look at these price targets, the stock doesn't have a lot of upside left considering the low-end and high-end price target, so this stock I would kind of rate as like maybe a C or a B stock. And that brings us to Nokia, ticker symbol NOK. And this is a Finnish technology communications giant that used to be one of the leading providers of telecommunications probably around 2 decades ago. However, Nokia fell out of popularity and their stock price was absolutely demolished because they did not catch up or even attach themselves to the smartphone transition, which was implemented by none other than Apple. However, some investors think that this company is making a major comeback due to Nokia's 5G networking solutions, and this is why the stock has been in many meme forums, and the stock price has also surged around 50% in 2021. So this company is a tempting buy because who doesn't like a underdog comeback story, and the rating for Portfolio Grader is also an A like the previous stocks that we just mentioned. The current stock price for Nokia, ticker symbol NOK, is $5.83. The low end price target is $6. The average price consensus among analysts is $7 per share, and the high-end price target is $8. And 11 analysts are covering this stock, so we can get some more confidence in these price targets because more analysts are actually putting in their price targets and studying this stock, their financials, their technicals, and other things that analysts study. So we can see that we can have more confidence in these price targets. However, again, we don't see huge upside potential, but it does have good 5G networking solutions that we should keep an eye on. However, I personally would probably go toward more of T-Mobile or AT&T or Verizon. However, that's just me personally. Up next, we have another fantastic dividend stock, and that's Prospect Capital, ticker symbol PSEC. This company is a BDC, which means it's a business development company, and Prospect Capital invests in U.S. middle market opportunities, as the article defines it. They currently have around $6.5 billion worth of assets spread over 375 various investments, with more than $3.5 billion worth of dividends declared, which is absolutely fantastic news. Now, I also personally own this stock. However, I got this stock extremely cheap at around $1 to $2, and right now it's trading substantially higher than that because over the past 12 months, the PSEC stock has delivered their investors around 56% growth at a current stock price of $8.76, and of course, naturally, Portfolio Grader rates this stock as an A, which means it's a decent stock to buy. However, I would not buy this stock at its current stock price. I got in very low because I thought it was a great dividend opportunity for constant growth during all of the lockdowns while things were pulling back, because I find dividends are extremely safe during market downtrends or bear markets. And the reason I think this is because the current stock price is $8.79. The low end estimate is $7, and that is also the same as the average price consensus and the high-end price target for the beginning of 2023. So I would not buy this company right now, even though this company is pretty solid and they have a decent dividend. It's just trading too high for my taste right now, and two analysts are currently covering the stock, and they both have an underperform rating for this company, so I am in complete agreement with them at this time. However, if the stock price pulls back to around maybe $3 to $4 or even $5, this could be a fantastic opportunity to get a decently good dividend stock in your portfolio that also trades at a very low price point. We all know that many companies lately have had disruptions in their global supply chains and even shortages. The demand for cargo ships is higher than ever, and it is increasing because the output for supplies needs to be caught up from the various lockdowns that happened around the world. This company literally offers various types of cargo ships, and it offers a good opportunity if we want to capitalize, at least trade this stock. I wouldn't say this is a long-term investment. I would say this is a decent trading opportunity. However, the opportunity may have already passed because the global supply chain is slowly correcting itself as time goes on. If you were wondering, the company currently owns around 12 Panamax ships, 7 Kamsarmax ships, 15 post-Panamax ships, and 5 capsize bulk cargo ships. In the third quarter, the company also reported pretty decent revenue of around $92.5 million, and that represents almost an 80% increase year over year, and it has currently gained in the last 12 months around 104%, which again is fantastic news if you were already invested into this company. But what about this company right now? Of course, Portfolio Grader rates the stock as an A, and what do analysts think of this stock? So we have very mixed opinions about the stock according to analysts, because the SB stock currently trades at $3.62. The low-end price target is $3 per share, the average price consensus is $5.86, and the high-end price prediction is $8 per share at the beginning of 2023, which is what these estimates are actually for. At this time, 5 analysts are covering the stock. However, I would like to see this company drop below $3 just to make it more safe, because especially if it's more of a small cap company. Now, with larger companies, we can kind of ignore that rule, but because all of these companies on this list are somewhat speculative and we're dealing with small cap companies, we really need to pay attention to what analysts are saying for these particular stocks, because the majority of small cap stocks are extremely risky, which brings us to a stock that I have talked about a lot on this channel, and that is Sensionics, ticker symbol SENS. And Sensionics actually has really game-changing technology that many other larger companies than them do not have, and this comes from their SENS continuous glucose monitoring system. The market for CGMs, also known as continuous glucose monitoring systems, according to the CDC in 2020 is absolutely huge. Just in 2020 alone, there were around 34.2 million diabetics in the US and another 88 million Americans who were pre-diabetic. Now, the best thing about this company is that they haven't even really tapped in to one of the largest diabetes markets, which is the United States. They are selling their SENS systems all over the world thanks to their various partnerships with other marketing companies that are doing this for them, and their largest competitive advantage is their technology, because they literally have the world's first long-term continuous glucose monitoring system that can last up to 90 days. This is also being extended, particularly in the United States. We're currently waiting on FDA approval for their 180-day system to come back so they can then market and sell this within the United States, and that is going to be a great catalyst for the SENS stock. To put this into perspective about their competitive advantage, other suppliers of CGM systems normally have to be replaced after every 2 weeks, and this is very inconvenient for many people with diabetes. Similar to Nokia, we have seen a lot of meme stock activity surrounding this stock with huge surges right now, and just in the last 12 months, the stock has given its investors around 205% worth of gains, which is pretty fantastic. Its current stock price trades for around $2.62 according to the article, but I have a more updated version of that because it's currently trading at around $2.79. The low-end price target by analysts is 80 cents, the average price consensus is $350, and the high-end price target is $6 per share. And for this particular stock, I would gravitate more toward the average price target because I think we could see some really good price action after the FDA approval catalyst comes through. However, that is most likely going to pull back to average around $3.50. However, we're going to have to wait and see. This company is also set to scale their revenues very nicely over the next 5 5 years, but the market capitalization is still rather high for my taste overall. But in the future, this could be a fantastic company because, again, they're a smaller company that's offering a technology that big players such as Abbott and Dexcom haven't even accessed yet. 7 analysts currently cover the stock, and they have very mixed opinions about the stock overall. They range anywhere from strong buy ratings to strong sell ratings. So right now, it's kind of up in the air of what analysts truly think about the stock, but I'll leave that up to you because Portfolio Grader automatically assigns this stock an A like all of the other stocks on our list. I also lastly want to point out that the author of this article does have positions in 3 of these stocks, and that would be ticker symbol III, ticker symbol PSEC, and ticker symbol SB. But what are your thoughts? I would love to hear your thoughts about these stocks. Comment down below another favorite stock that's trading below $10 that you are invested in and that you really like that should be on this list. Remember to smash the like button right now if you haven't already, subscribe if you are new, and I will see you in the next YT video.